Morning. I think firstly, just from PSG Asset Management side, thank you very much for attending today's roadshow presentation. I think if I look at the market at the moment as well, it seems PSG was like the first mover or the bold one to actually start with face-to-face events. So we really appreciate it because initially we actually said, what a gamble. Then just on that, the Cape Town Roadshow is the last one. We've actually already traveled through the country. And at one of the larger venues, we're using a registration company as well. And the guy that was actually working there came to me, and it was in Pretoria, and he said, just look at the clients. Just look how happy they seem to be. And I must say, I think even here in Cape Town today, there's a lot of you that haven't actually seen each other for more than 12 months. So it's really awesome and amazing seeing all of you again. Then one of our fund managers is here today as well, part of our fixed interest team, Lal Sankar. And I just want to say, Lal and the fixed interest team and the investment team, well done with your Raging Bull Award that you've won for the PSG Income Fund. I know you're getting a lot of newsletters and a lot of emails, and one cannot read all of them. But I think after today's session, if you've listened to our message, maybe just have a quick look at some of the articles that we've actually written, and just to see our actually thought of mind. And then leading on to that, I think out of all the presentations that we've done over the last number of years, that is potentially maybe one of the most important presentations that we've actually done. And the reason why we're just saying that is that if we look at the market itself, it seems there might be an inflection point. And just looking at the evidence behind that, I think those of you that have actually followed it would have seen that the market have actually been up and down significantly. The NASDAQ index, year to date, down 12-13%. Then even a darling favorite of the market, Netflix. I saw this morning it's down 32%. Last week it was actually down 38-39%. So quite volatile, but I'm not going to go into a lot of detail. I'm going to leave that to the two fund managers to talk about what we believe can potentially happen in the market itself. Then just the two fund managers here today. The one is John Gilchrist. He's our Deputy Chief Investment Officer, and he's a manager on PSG Stable, as well as PSG Diversified Income Fund. And then our second manager is Gustav Schulenburg. He's a manager on the equity funds. But without further ado, I'd now like to hand over to John Gilchrist. Thank you very much.
Thanks very much, Charles. I just want to reiterate what Charles said. It's an absolute pleasure to be here today and actually physically interacting with clients. If I rewind a year ago, a colleague of mine, Mikhail, and I did the Outlook 2021, and we actually did it in this venue. It wasn't quite as wide as this, but it was certainly a large portion of this venue, and it was recorded live. And I stood on the stage staring out at an empty audience, and I looked at the sound engineer, and I had to pretend he was one of our clients and that he was interested in what I had to say. So I can tell you this is a whole lot better. So thanks very much for coming through today. What we're going to cover, the main message today, and probably something that's on your guys' minds, is us at PSG Asset Management, we've had a great recovery after a tough period, and we've done an exceptional performance for the last 18 months. And the obvious question is that performance going to continue? And we're going to outline why we think we're actually at the early stages of an outperformance cycle. For those of you watching the markets, there's also another ancillary thing that we will cover. We believe that our differentiated thinking and our differentiated positioning will stand us in really good stead if we have what we've already seen in January, volatility, drawdowns on the back of a withdrawal of monetary stimulus. So we'll be covering both of those aspects. I'll have a look through the big picture and talk about fixed income before turning over to Gustav, who will talk about the equities, both global and local, as well as our positioning. Now, when it comes to the big picture, most of you will know PSG Asset Management is a bottom-up house, but we are macro aware. And given everything that's happening in markets at the moment, given how important the monetary stimulus debate is at the moment, we decided to spend a little bit of time on that. And I think, once again, what we've seen year to date in the markets, the big swings, all the focus on what's happening with the Fed, what's happening with the ECB, BOE, etc., indicates that this is something that we need to be cognizant of and aware of. But before I delve into that, let's just cast our minds back a year. At the time, at our Outlook, we were very positive on SA assets, and it was quite a difficult sell. And it's not surprising if you think back over the previous 5-year period. So the 5 years leading up to early 2020, or early 2021, the period ending 2020, SA equities had done about 6.5% per annum over the previous 5 years. If you look at small caps, they'd actually been flat, and the likes of listed property had dropped on average 8.4% per year. It's not surprising that people struggled to see opportunities within the SA space. But we've said it a number of times, and I'm sure we'll say it again, even if the narrative doesn't change, even if the outlook for a lot of people looks negative, assets can become too cheap and can bounce from those oversold, really cheap positions. And that's exactly what we saw in 2021. We saw SA equities delivering a decent return after a tough 5-year period, and small caps outperforming substantially. The PSG SA Equity Fund had a great year, and Gustav will go into a bit more detail as to what worked and what we still think is going to work going forward. Looking at some of the other asset classes, I mentioned how tough the previous 5 years had been for listed property, a great rebound there. And not a lot of people know that preference shares were actually the best performing asset class last year, delivering 45%. Our PSG Diversified Income Fund was able to leverage off bonds, but also utilize some of these other asset classes, equities, listed property, pref shares, the inflation-linked bonds, to continue to deliver exceptional performance. And that's also over the longer term, the performance has been great. And then on the global side, even though, as you'll see a little bit later, the environment was not necessarily the best environment for our approach to investing, stock picking meant that we were able to outperform. Now, we're not for 1 minute saying that 1 year performance is the appropriate period over which to judge an asset manager. All we wanted to point out was 2 things. Is firstly, assets, even if the narrative remains negative, assets can become too cheap and can bounce from there. And secondly, to say, yes, we've had great performance, we think this is just the start. And there are a couple of slides that Gustav will go into that we believe illustrate that point really nicely. What we show over here is the average 10-year US GDP going back to 1960. So the first point there is the average 10-year US GDP per year from 1960 through to 1970. And you'll see averaging sort of 3.5%, 3%, 4%. The last 12 years have been an incredibly tough environment for growth within the US. Now, a lot of you would have seen a lot about monetary stimulus. The Fed funds rate still effectively at 0, and a massive amount of monetary stimulus, generally in the form of bond buying. To put that into context, the US Fed, their balance sheet as a percentage of US GDP stands at 38%. Before COVID, it was 19%. Before the global financial crisis, it was 6%. Alternatively, if you look at the G4, their central bank's balance sheets, that totals $26 trillion. It's a number that I think most of us struggle to comprehend once you get into trillions. $26 trillion, up from about $15 trillion before COVID. So you've had this wall of money in terms of monetary stimulus going into the markets ever since the GFC, and you've had anemic growth over that period. The obvious question is why? Well, if we cast our mind back, going into the GFC, households were massively indebted, banks were running at incredible levels of gearing, and so we've had essentially a de-gearing period. And when you combine monetary stimulus with de-gearing, you don't get economic growth. What you do get is rises in certain asset classes and certain asset prices. Now, it's not surprising with this huge amount of bond buying that I referred to, that you've seen here is the 10-year US bond yield. You've seen simply a continuation of this 40-year bull market in bonds. US Fed rate really low, that huge amount of bond buying as we indicated. What's really interesting as well, though, is that if you have a look at inflation, it's been low throughout this period as well. And if you recall, after the global financial crisis, there was a lot of debate. Would all this monetary stimulus drive inflation? But because of those low growth, because of the de-gearing effect, and because of lots of specific disinflationary effects, we actually didn't see inflation coming through. It remained very, very controlled up until the end of last year. Now, 2021 was dominated by discussions around, is inflation in the US transitory or not? And the Fed was adamant that it was transitory, that it would literally just be a bump from the lockdowns of COVID. It would be a bump and it would resume normal service. And eventually, at the end of last year, they admitted that it's not transitory. What's interesting, though, is we've seen this bump of inflation over here, and the markets are still assuming, if you have a look in terms of what's priced into assets, that inflation is going to be in the US about 2.4% per year for the next 10 years. They're basically assuming that it's not transitory, but it certainly will wash through the system within the next year or two. Now, once again, I highlight this environment over here over the last 12 years since the global financial crisis. And this shows, for the S&P 500, it shows growth versus value. And when the line moves down, it indicates that growth is outperforming. And not surprisingly, over this exact same period where we've had abnormally low growth, abnormally low interest rates, abnormally low inflation, growth has outperformed. It's the perfect environment for growth type assets. And if you think about it, firstly, growth is a bit anemic. Anything that's scarce gets bid up. That'll be a support for growth type of assets. But more importantly, growth assets generally generate their profits and their cash flows further out in the future. And they benefit from low interest rates, just from a discounting effect. And so low interest rates, low growth, both of those factors are very supportive for growth assets. And it's no coincidence that over that same period, with that abnormal low growth rate, abnormal interest rates in terms of being low and abnormal inflation, growth has outperformed. If you cast your mind back to November 2020, Pfizer and Moderna announced that they'd actually had breakthroughs on the vaccine, and suddenly the world looked beyond a COVID environment, saw potentially more broad-based growth, saw potentially a normalization of interest rates, even potentially some inflation, and you saw value outperform. But it was a small little blip over there, and then normal service resumed. Year to date, certainly value has once again come to the fore, and it has outperformed substantially already in January. The other thing I just want to point out here is if you cast your eye back over the history, you can see there are periods where value very sharply and aggressively outperforms growth, most notably after the dot-com in the early 2000s. And so I think we've been in an environment of that. People kind of assume that's going to continue. We just want to caution that sometimes it reverses and reverses quite aggressively. Certainly for those that are sort of value biased in their style, I think they can relate to this picture over here. And my wife said, no, you can't put that up. That's really mean. But I think she's got a soft spot for certainly Russell Crowe on the left-hand side. But we can certainly relate to how this feels. If you have a look in terms of the outlook for developed market inflation, you can have a look at a bunch of different things, and a lot of our competitors will go into that in a lot of detail. You can have a look at wages and the fact that wages are moving swiftly upward across all industries within the US. You can have a look at the great resignation it's being referred to, where people have pulled themselves out of the labor pool in the US. Whatever it is, we're seeing sustained and aggressive moves in terms of wages. Or you can have a look at property prices in the US and the increases that we saw last year, roughly 20% increases in property prices, and the fact that that has a delayed effect through owner's equivalent rent into CPI. Or you can have a look at energy prices and the outlook from that from a supply and demand perspective. And all of those will point towards higher inflation for longer within the US. But we think if you have to put up one chart, the most important chart is this one. And this shows the federal budget deficit in the US as a percentage of GDP. Now, if we rewind to after the global financial crisis, yes, into a recession, your fiscal deficit is going to increase, but the general consensus in Washington was to basically implement austerity. They didn't want the deficit getting out of hand, and so they very quickly made sure that that normalized. Fast forward to COVID, and to be honest, there's less political will to embark on austerity. And so we've seen the fiscal deficits blow out. But you know what's interesting to me is after the global financial crisis, there was this almost academic debate around helicopter money. And the concept was that if the Fed needed growth, or if they needed inflation, literally they could fly around with a helicopter and throw money out of the doors. 2 people, and that would actually drive inflation and growth. And it was kind of a theoretical debate, but essentially, post-COVID, that's what we did see in the US. We saw checks being mailed out to individuals. And we believe, essentially, that Pandora's box has been opened. We think that regardless of whether Republicans or Democrats are in charge, the use of fiscal stimulus is likely to be higher going forward. Just some evidence on that. In November last year, the bipartisan infrastructure bill was passed in the US. That's a $1.2 trillion bill, and you would have heard all the debates and discussions around the Build Back Better $1.8 trillion bill. So fiscal stimulus is likely to be something that we live with going forward. If you have a look on the growth side, in addition to the fiscal stimulus, which is likely to drive growth, you've also got a number of other factors that, to us, point to a growth type of environment. Firstly, US households. It's amazing to think that through a pandemic, the US, the UK, Japan, all of those countries, households have actually come out of it in much better shape than they went into it. So in the US, household wealth as a percentage of GDP is up to 125%. It's the highest it's ever been. If you have a look at net debt of households as a percent of GDP, I mentioned that was high going into the global financial crisis. It got to nearly 100%. That's now down at 76%. And if you have a look at the costs of servicing debt, it certainly has never been lower for at least the last 40 to 50 years. So households are in great shape, and they're ready to spend. We've talked about higher wages, and higher wages end up in people's pockets, and they spend that money. It drives the economy. It's not like higher asset prices, which doesn't necessarily translate into economic growth. ESG and infrastructure spending. I looked at some analysis on it the other day, and there was some further analysis I saw that came out this morning. But the initial assumptions were that if we're going to get to net zero by 2050, I saw estimates of $20 trillion through to $140 trillion of spending. I see McKinsey's came out with a report. I haven't looked at it in detail, but the headline was $9.4 trillion of spending per year out to 2050 in order to basically rejig our entire global economy to move from fossil fuels to renewables. I mean, to put it in context, these numbers are too big to easily comprehend, but the global GDP is $85 trillion. It's a rework of the entire global economy, and that is likely to drive growth. CapEx, companies are looking at the fact that households in the US are ready, willing, and able to spend, but they've also had tough experiences in terms of their supply chain. They all went to this just-in-time, efficient supply chain, and it's failed them and continues to fail them with bottlenecks at ports. And so they're likely to diversify. The combination of that is likely to drive CapEx, which once again will drive growth. And then the one point that I didn't put on the slide, but is really important, is back in the global financial crisis, banks were clearly on the back foot. They are in very good shape right now, and they're keen and able to lend. The combination for us indicates that there's a possibility of much better growth going forward. And the combination of all of that is you've got, even though we know monetary stimulus is being reduced, it's still incredibly accommodative. Right now, you've got the Fed funds rate at 0 and inflation at 7%. Even if that Fed funds rate moves to 1%, 1.5%, and inflation comes down to 4%, it's still incredibly accommodative. You've got potential growth drivers. You've got the fiscal taps fully open. We put that all together, and to our mind, that does indicate the potential for inflation higher than what we've seen over the last 12 years. Now, we don't try to predict these things. All we're saying is we look at all of this, and it's an indication to us that the last 12 years may be the anomaly, and we might be moving into a different type of environment. The obvious question then is, well, if we have higher inflation, what has worked historically in a high inflation environment? And we had to go back to sort of 1967 through to 1980 because we haven't had recent nice bouts of inflation that we can really draw good data from. And we looked what worked under that environment. And you'll see here, value type stocks outperformed both CPI and US equities, and clearly growth would have underperformed in that environment. And that makes sense because in a high inflation, high interest rate environment, value shares that deliver cash flows shorter term are going to do better than shares that deliver returns and cash flows further out in the future. If we unpack that a little bit more, energy stocks, mining stocks, commodity stocks outperformed value even under that environment. So you had those stocks, then value ahead of the market. The obvious question is, well, that's 40 years ago. Does it still apply today? Do the same sort of trends still occur in markets today? Now, as I said, we don't have a nice, juicy inflationary period to have a look at, so we decided to slice and dice and have a look at the data. And what we did is we went back to April 2020, and we literally looked on a weekly basis, did the 10-year bond yield go up or did it go down? And depending whether it went up or down for the week, we bucketed returns for various asset classes into the down bucket or the up bucket. And then we pulled that all together and said, what does that show us? Cumulatively, in the weeks when the 10-year yield was down, we had the growth outperforming. These are all relative to the MSCI world, value underperforming, and commodity-type stocks underperforming most. Conversely, when you had the 10-year yield up, which for us is indicative of potentially an inflationary type of environment, you had growth underperforming, value outperforming, and commodities outperforming a lot. So essentially, over the last year and a half, 2 years, we've had the same sort of trends as we saw in that period, 1967 to 1980. So it leads us to think if we have higher inflation, this is likely to be the ongoing sort of environment in terms of what will outperform. Now, we've outlined an environment where, as we've shown, we've tried to show the longer-term data, and we've tried to show that the last 12 years has been an abnormal period with low growth, low interest rates, low inflation, and we've outlined that that could potentially change. There are a lot of indications that there could be an inflection point. The obvious question is, well, how is the market positioned? And this is a little bit of a complicated chart, but it's a very, very important chart. So I'm just going to spend a minute or two explaining it. So essentially what we've got, the red line are the shares that do best when there are falling bond yields. And the black line are the shares that do best when there are rising bond yields. And what we've seen, and on the vertical axis, we have essentially the rating. And what we've seen is that the shares that do best when they're falling bond yields have become more and more and more and more and more expensive. And those that do badly when they're falling bond yields have become actually quite cheap. And I was trying to think of an analogy to almost explain this. And it's not a great analogy, but it's the best I've got so far. It's almost like you're in the rainy season and everybody wants an umbrella. And so the price of umbrella gets bid up and bid up and bid up. But to our mind, we're now sitting at the end of the rainy season. We're about to go into a hot period, and the price of umbrellas has never been higher. And nobody wants to pay anything for sun cream. It just seems a little bit extreme to us that the environment where there's less likely to be tailwinds in terms of lower bond yields. In fact, we can see exactly the opposite. People are willing to pay 26, 20, 27 times 2-year forward earnings for these type of shares. And in fact, if we look in January with all the turbulence, the shares with the highest price earnings were off 14%. Those with the lowest price earnings were only off 2%. So this sort of extreme environment, we don't believe is likely to last. Now, as I said up front, we're a bottom-up house. So we pick our shares regardless of the environment. We look at the fundamentals and we say, we're happy to hold these through the longer term and we believe they will outperform. So we're not necessarily saying we're basing our share picks on this. But what we do say is if the red line comes down and the black line goes up, that's additional performance that we'll pick up in terms of outperformance over and above shares that we believe stand on their own 2 feet regardless of the environment. So for us, this is almost extra cream on top, potentially. Now, the obvious question is, why, given the last 12 years has been an unusual period, given that it looks like there are a lot of indications that we could have an inflection point and a change going forward, why are people still sticking with what worked yesterday? And you don't need to look much further than Daniel Kahneman. A number of you may know of him. I would highly recommend his books. He's a Nobel laureate, and he's focused on behavioral finance. And he points out that all of us are subject to cognitive biases, and investors, same as everybody else, subject to the same cognitive biases. And the one that's probably most relevant here is the recency bias. As humans, we assume that what happened recently will continue, and what's happening today will continue into the future. We struggle to anticipate an inflection point. We also are inherently lazy. We take shortcuts in terms of how we look at things, and one of those shortcuts is we generalize. And the problem is Financial markets are incredibly complicated. And if you generalize, you lose the subtlety, you lose the nuance. But these sort of generalizations become market sentiment and become market accepted. So a good example would be in the US a year or so ago, it was you cannot invest in US retail investments in shopping centers. Amazon is going to destroy the shopping center. Gustav will show just how well we did with some US REIT investments that we had in the US. And then really importantly, incentives are absolutely key. Charlie Munger said once, show me the incentive and I'll show you the outcome. And when it comes to asset managers, the absolute cardinal sin is to be different and wrong. That's a career-ending mistake. And as a result, people tend to move towards the benchmark, and they become very benchmark-focused. And even if they say they're not benchmark-focused, I promise you, they're all looking over their shoulder and saying, what is the other guy doing? They don't want to be too different. And so that means that people stay with what's worked, looking over their shoulder, and it's only when everybody moves that everybody rushes to the door at the same time, and they can't actually get out. Essentially what we're saying is, what if tomorrow looks different from yesterday? And what one needs to navigate that environment is an open-minded, pragmatic approach. Most of you will be familiar with our 3M philosophy, and we believe we have exactly that open-minded, pragmatic approach because of our 3M philosophy, focusing on moat, management, and margin of safety. We're not benchmark cognizant, we're benchmark agnostic, we don't have strategic asset allocation, we're willing to be patient and look long-term, and so we believe we're actually in the right position to take advantage of these sort of environments. In summary, we're simply saying what has worked historically, and especially in this last 12 years, which is an unusual environment, if you look longer term, may not work going forward. We could have a total switch around from low interest rates, low growth, low inflation, through to the exact opposite. And those long duration tech type assets, US dollar treasury bills that have worked well, could potentially be the laggards of the future. In an environment where you have increasing inflation, increasing growth, increasing interest rates, short duration assets, value type shares, those that deliver high dividend yields, those that deliver value short term, and commodity type of stocks are likely to outperform. I'm now going to briefly go through fixed income and why we think there's still legs within the space. I know it's not necessarily a differentiated call to a lot of our peers, so I'll move through it relatively quickly. Firstly, when we have a look, this is the 10-year bond yield going back to 2012. And you can see over the last 5-6 years, it's pretty much moved sideways. You haven't had any capital gains really from holding a 10-year bond. Despite that, because the yield is so high, you've actually had decent returns from essentially a risk-free asset. You've had good inflation-beating returns, and especially up until 2020, it was significantly ahead of what equities had delivered over that period. So that yield has generated good returns for investors. If we have a look at the bond yield, firstly the yield at the end of December, and then I contrast that in green to the bond yield at the end of 2019. And you'll see, as we all know, repo rate was dropped. So this is the yield on bonds, and this is the term to maturity. And on the short side, the repo rate has dropped. The SARB's been very aggressive to do that. And then with COVID, plus the SOE bailouts, plus the costs associated with COVID, the impact on growth, risk has increased, and as a result, longer-term bond yields have moved up. Now, bond attractiveness is very much driven by the real yield, the differential between the nominal yield and inflation. And if we go back a couple of years, the market assumed that the Reserve Bank was targeting a sort of 6%. On that 3 to 6% inflation target, they assumed that 6% is what would come out. But the Reserve Bank has done a phenomenal job in terms of moving down those expectations, and they've dropped down to the middle of that 3 to 6% range, 4.5%. And if you just look mathematically, simplistically, the margin of safety has moved from this still very attractive margin of safety to an incredibly attractive margin of safety, one of the most attractive real yields available on any assets globally. It really is very, very attractive. But this is clearly just one side of the equation. They look attractive, but what about the risks? We try to keep this simple in terms of how we communicate it, but obviously we have a look and do a huge amount of work in terms of all the risks underlying our bond position. The key thing for us, the question is like, when does debt become unsustainable? And for us, the key thing is to say, is the market still absorbing the supply? So to put it in context, about 3.9 billion of nominal bonds are issued every week, and about 1.2 billion of inflation-linked bonds, and that's being easily absorbed by the market right now. And we look at it in terms of the risks and 5 key pillars. Firstly, monetary policy and inflation. I've already talked a little bit about the Reserve Bank. Letseko Kgonyago has done a phenomenal job at reducing those inflation expectations and really doing a credible job, and we're very comfortable that going forward, they have the credibility, they're going to keep inflation in check. Prudent fiscal commitment, I think both under Tito Mboweni and now under Enoch Gondongwana, they've done a really credible job of pointing out that we are fiscally constrained and pushing back at public sector wage increases and the like. So they definitely are holding the line in terms of that prudent fiscal commitment. When it comes to sustainable debt, it's amazing to me. You think back 5 years, debt to GDP was at 46%. It's around 70% now. It's probably going to peak at about 78%. So that clearly is something we show a little bit of a crack there. It's something we look at very, very closely. But we do believe, having done our analysis, that that will peak at 78% and will come down. And the one interesting thing is that the numbers on that 78% are premised on about 1.7% growth rate per year. We've already seen what could be a 200 billion rand overrun this year from commodities doing well. And if we have, as we've outlined, potentially a stronger commodity cycle, that could be good for growth. Now, the nice thing about debt to GDP is if you have higher growth, you have higher tax receipts, you borrow less, but also your growth goes up. And so that debt to GDP can move quite quickly with both the numerator and the denominator moving in your favor. Liquid functioning market, I've said we do have that. It's operating well. And then finally, confidence. You know, whenever we talk about fixed income, whenever we have any sort of positive comments about SA Inc. generally or SA bonds, people point out all the issues that we face every day. We see it, whether it's corruption, whether it's frustrations in terms of not moving ahead on structural reforms. We acknowledge all of that, and we acknowledge that confidence is absolutely key to drive growth, which is the key thing to bring that debt to GDP down and bring confidence back into the market. So that's something, once again, we have a crack there according to that. But certainly confidence can move quickly, and certainly what we've seen on the commodity side could flow through generally across the economy. Finally, when we look at bonds, we think this is incredibly powerful to have a look at the asymmetry and look at some scenarios. So if you go out today and you buy a 10-year South African bond, the yield is 9.7%. In fact, it's probably down to about 9.6%. We've been on the road for a couple of weeks. And so if nothing happens, in a year's time, you've generated 9.7%. So probably inflation plus 4%, something in that sort of range, depending on what CPI we see this year. So a really decent return from a risk-free asset. If yields were to blow out, and we've taken quite an extreme scenario here where the bond yields move out 2%, yes, over a year you could lose a little bit of money. But conversely, if positivity were to come in and you were to have bond yields dropping, and remember, bond yields dropping means the price of bonds goes up, you could actually have a 22% return from bonds. I mean, that's a good return in anybody's book. If we sort of probability weight these type of scenarios, you can see why we think this is still very, very attractive. If you look at it slightly differently and you say, well, if I don't invest in bonds, if I go into cash, well, you're actually giving up 6% to go into cash. Before COVID, that gap was about 2.5% between bonds and cash. Now it's 6%. It's a huge opportunity cost. Obviously, you're getting your 9.7%. It's almost like you bank it at the beginning of the year, and if nothing changes, that's what you're going to receive. So that's very, very powerful. Also, you know, I didn't go into a lot of detail on it, but that yield curve is downward sloping. And if you buy a 10-year bond, and after a year you've got a 9-year bond, if that yield drops down according to that curve, you get an additional 2%. So your worst case scenario, your left tail could actually be 0 under that sort of environment. And then we've talked a lot about US Treasuries, the potential for interest rate rises there. The obvious question is, well, what happens to bonds under that environment? We've got an 8% premium. Our bond yield's 9.7 versus the US 10-year bond yield at 1.7 effectively. Now, that's obviously in different currencies, but it still is a significant buffer for us in terms of if that were to blow out. I'm now going to hand over to Gustav, who will take you through our thinking and why we think there's lots more opportunity within global and local equities. Thank you.
Afternoon, everyone, and thanks for coming out and spending a bit of time with us today. So 2 key points that I'd like to convey about the equity opportunity that we see. The first is how important it is to understand that cycles remain relevant and to understand where we are potentially in a cycle, what the opportunities and risks are for your clients. And then the second point is to understand why we believe the opportunity set embedded in our funds is still significant, what excites us, why we think this recovery could be in its infancy. But first thing is to dispel something we've heard where we're very pleased with what we've delivered for clients over the last 18 months, but we've heard some investors and clients comment that perhaps it's too late, we've performed very well, the opportunity in PSG's funds is not as attractive as it was. We don't think that's necessarily the truth. So what we did is we went back in history and we had a look at 100 Rand invested at the bottom after each financial crisis. And what happened subsequently? And we used the PSG Equity Fund because we believe it's the most relevant proxy for the market. And what's important to note here is where we are. The red line is the current recovery since the COVID lows. The important thing to note is the months, okay, the duration of the recovery. We're talking 50 to 60 months that previous recoveries have lasted, especially if we look at the 2008 and 2003 starting points. And this, consider the quantum of the 100 Rand invested, where it gets to, okay? That gives us confidence that we're not approaching the end of the recovery. We don't try to make forecasts on the future, but if history repeats itself, there's probably legs to this and significant legs. Secondly, what's important to acknowledge is one could make an argument that the COVID lows, after all of the stimulus, after all of the kind of melee in the market, that the base could be even lower. So you could have a situation where the recovery lasts longer and is even stronger simply because of where we are in the cycle and how low the starting base was. So we had a look at funds, and we took our global equity fund, and we had a look at 2021. What performed well, what didn't? And what we thought was interesting is that certain sectors performed very well, certain stocks performed very well, and some didn't. Now, whilst this pleases us because it gives us comfort that our funds are well diversified and not binary, we're not taking single bets on tech or PGMs or energy or consumer spending. We've diversified our portfolios well, and that leads to situations like this, where you're shipping stocks. US property that John referenced, they perform well. But some of our highest conviction stocks, Asahi, Japanese Brewer, Prudential, Hiscox, Liberty Global, they have not performed as well in 2021. That gives us confidence that these will drive future performance. They remain high conviction. They remain key holdings for our clients. We remain as excited about them as ever. But they just didn't perform as well. And that there's a pleasing aspect to that everything doesn't fire at the same time. That's good for clients. That leads to long-term outperformance and a diverse portfolio. Did the same locally. The leisure stocks, hospitality was priced for destruction, like lockdown would never end. In the midst of the crisis last year, March, April, these stocks were priced for destruction. They had to adapt to survive. They had to improve their operations materially to survive. We liked that. We liked the price we were paying. The assumption that lockdown would never end, we thought was excessive and probably not true. And these businesses were improving their operations to survive. Clients did very well. Some of these stocks, buyers have come for them. Distell's getting taken out by Heineken, Long for Life by potentially Old Mutual Private Equity, and Imperial by Dubai World. These stocks have done well, smart money chasing them, and we'll get onto that in a second. Other examples, Glencore, some good SA companies like Udeco, Motus, Robex, Very good companies. Same situation as in the global fund. Some of our key holdings, some of our highest conviction bets in 2021 didn't perform as well as some of the other stocks. That's not a bad thing. That means our portfolios are well diversified and the opportunity set remains. Companies like ABI, Discovery, JSE, we still remain of the opinion these are very, very good companies that are well run and have material upside. You're underappreciated quality. So that gives us confidence, going back to my first point, that the recovery isn't necessarily done. We would caution investors to view our funds as potentially a poorer place right now, given the recent outperformance. It's not necessarily that simple. Then cycles, where we are in the cycle. We talked about that. So this chart shows the US versus other developed markets. So essentially Japan and the UK versus the US. In the purple patches is when the ex-US markets, the other developed markets, outperform the US, and the gray is when the US outperforms. Now what's important to realize here is where we are right now. So the US has outperformed for such a long time, and to such an extent that we think there's risk there. Our point is that cycles remain relevant. It's not a new normal. And understanding where we are in the cycle is critical with us. When one then looks at the US specifically, the market that has outperformed by such an extent, just showed that. And we look at the top 10 stocks as a percentage of the index. We've often put up a slide that shows the top 5 stocks ahead of .com levels. Look at the top 10 stocks. They're at 31% of the index. Okay, that means the other 490 stocks only account for 69% of the index. So people view the passives and index trackers as potentially low risk. $10 invested in the S&P 500 right now. $3.10 goes into 10 stocks, and the other $6.90 goes into other 490 companies. There's a potential opportunity and a risk in that. In our view, there's a risk buying these 10 companies. We can see where they are. If the cycle remains, which we don't think there's any reason for a cycle to not exist, then these stocks could underperform. These 10 stocks that have become so big in the index. If you overlay that with the previous slide and you consider how much the US has outperformed, then these 10 stocks could underperform an index, which is underperforming the rest. That's assuming that there is a normal cycle. So we would caution investors to consider, what if tomorrow looks different from yesterday? Just as John put up on his slide. What if these 10 stocks don't turn out to be the winners? What if these 10 stocks are where the risk is? What if the US is where the risk is relative to others? Consider that. It comes down to an open-minded approach. Bringing it closer to home, emerging markets. So not too dissimilar. Blue line is energy and materials, going back to 98. Yellow line is consumer discretionary and tech. Okay? Right now, 50% of the index is tech and consumer. So buying a passive fund for the MSCI emerging markets, that's what you get. But what's more important is to see how much it's outperformed, how far it's gone versus the basic materials. Basic materials down from 37% to 13% since 2008 as a percentage of the index. Consumer stocks 26 to 50. Anyone who's bought the tech and consumer stocks has done very well up to now. What we're saying is consider that a cycle will exist. Where we are in the cycle is relevant. Yesterday and tomorrow might look very different. Tech and consumer is now half the index. It's outperformed materially. Be careful to assume that it will continue. So what does that look like when it happens? We had a look at the 5 years after the .com bubble, see what happens on the NASDAQ. So the 5 years, the NASDAQ halved your money for you. Okay? No one rings the bell and says, right, party's over in tech, move. Energy, materials, the unloved sectors at that time, for the 5 years subsequent, materially outperformed. Many investors investing in the tech stocks, the Ciscos of the world, Microsofts of the world in 2000, were left with their money halved for the next 5 years. it's important to understand where we are in a cycle. It doesn't just continue. There's not necessarily a new normal. So we had a look at 2 companies we've owned at various times for clients in the last few years, and we had a look at what factually happened to those 2 companies. One's SAB, now owned by Anheuser-Busch, and the other one's Microsoft. What happened post.com? So 100 Rand invested at the crash. 5 years later, you still had lost half your money, more than half your money, if you owned Microsoft. It remained a very good business, very good investment at times, but not if you get it on the wrong side of the cycle. It's a company we did very well out of. Unfortunately, sold out too early, but we typically will do that if we think prices are getting too high. But look at what happened to SAB. It was unloved when it started. It wasn't as sexy as the tech stocks, and it turned out to be a very good investment. More than doubled your money in the 5 years subsequent to .com. So there's opportunities and risks. It's not about running away because there's risk. There's opportunity in this when the market gets stretched. So we don't make macro forecasts. John spoke about that. But what we do try to do is just be aware of what's going on. So we try to test the temperature of the market. And one way we try and test the temperature of the market is we look at something like this. So this is a number of IPOs in the US since 95. And look where we are right now. Okay? All-time high, well, not all-time highs, but since 95, highest level. Okay? IPOs, companies listing. Now, what is an IPO? It's smart insiders selling the company to the market. Now, I don't know about you guys, but I don't know many business owners that sell their businesses just before the good times are about to arrive. They typically know more, and they typically sell a portion of their business or all of the business when the time is right. And the time is right to get out. But when it's an IPO, the market is going. The market's hot. The market's happy to buy it. Ignoring the risks, debt is cheap. It's a dangerous place to invest. It's a dangerous time to invest. So we had a look at the JSE. The chart shows the ratio of listings versus delistings on the JSE going back to 95. When it's high, there's more listings than delistings. When it's low, obviously, there's delistings. And we did the numbers on it. And the average subsequent 5-year return, when there was a lot of listings, was 9% per annum. When there's a lot of delistings, it's 18% per annum. Okay? So where the US is right now is there's a lot of listings. It's in the top half of this graph. Typically not the best time to invest. You're paying quite a high price, and you could take a long time to realize a good investment. When confidence is low, delistings are happening, it typically leads to a better outcome for clients to invest at that time. What's happening in SA is smart insiders are buying companies from the market. Heineken's not buying Distell because they think it's going to be a terrible investment. Mutual private equity is not trying to buy Long for Life because they think it's a terrible investment. The other examples here, Afrox, Pioneer Foods, 2 companies are fighting over Royal Bafokeng Platinum. These are smart insiders trying to buy companies from the market. They might think the price is too low, or they think good times are ahead, or better times are ahead. That typically is a good time for us to invest. Now, unfortunately, some of these companies are taken off our hands by shareholders that are voting in favor of prices that are too low. But the key point is, where are we? What is the temperature of the market? Where are we in the cycle? Where is the opportunity set? So then, another data point which we think is relevant is if we look at commodity producers and the capex that they're spending. Okay, it is dropping. The year-over-year change is negative. Miners, energy companies, commodity companies, they're not investing. Why are they not investing? Well, firstly, they can't find funding because the banks tell them they're not cool enough on ESG metrics. Can't fund it, or funding's too expensive. They've allocated capital poorly in the past, so shareholders aren't happy for them to invest and grow and dig new mines and drill new rigs. But the consequence of that is a constrained supply. There's no new supply coming on. So what happens when the demand recovers or even exceeds expectations? Then the release valve has to be the price going up. Once again, that's where the opportunity is. In the energy sector, it's not too dissimilar. Look at the rig count for oil and gas. Now, there's a reason why oil and gas prices are where they are right now, because demand is not subsiding, but there's no supply that's starting to come on. And we can see it's not like you drill an oil rig in a week or two. We can see that in the short term, there are no more rigs being drilled. There's no more supply coming on, or not sufficient supply to compensate for demand. That's where the opportunity is in the oil sector. When you go back to the slide that I showed, the 5 years post the dot-com crash, top performing sector, energy. This is what happens. It's a cycle. It's a natural cycle. And the evidence that we're seeing suggests that this cycle could be starting to turn away from what worked over the last decade. Talked about fossil fuels and green energy. It's interesting, if you look from 1965 to 2019, percentage of global energy that's consumed by fossil fuels in gray. And the blue is nuclear and the orange is renewables. Okay? We think the principle behind ESG is very sound. But what investors are missing is how much time it'll take and the size of the project to get to net zero emissions. We think getting there by 2050 will be unaffordable if possible. So the point is that in that exists an opportunity in terms of energy. We don't think it's smart to conclude coal mining companies are uninvestable, because we think it's going to take a long time for coal to vanish as a source of baseload energy. And that creates an opportunity, because we've just seen that supply is not coming on, demand is clearly not vanishing. So what happens? The price has to go up. Okay? And it's probably better for us as shareholders to be involved in a company and help them along the way to improve ESG than to sit on the sidelines and throw stones at them and say, it's not ESG friendly. Perhaps it's a better way for shareholders to engage, but I suppose that's a different topic. Copper, old world commodity. We think investors would be surprised to see how much copper, the old world metal, that's mined in these unpalatable jurisdictions, how much copper is used in the new world economy of clean energy. Almost 100 kgs of copper goes into an electric vehicle versus less than 30 in normal combustion vehicles. Okay, so if the Teslas and the electric vehicles and battery vehicles come on, we're going to need a lot more copper. But no one's mining extra copper because it's in Chile, it's in the DRC, it's in Zambia, it's in these unpopular geographies where banks are not willing to fund it. Same with wind. Wind versus hydro and coal, a lot more copper being used in those. So we think it's dangerous for clients to conclude that something like copper or coal is uninvestable because it's part of the old world economy. It's part of, undersea cables, and it's part of telecom lines, and it's part of coal fire stations. It's not that simple. But you have a situation where there's no more supply coming on, and that creates an opportunity for us, as long as one is open-minded and pragmatic about the evidence, rather than the emotional narrative, like John said. Amazon's going to kill all retail. Our clients did pretty well out of US retail properties in the last 2 years. This is another example. So then looking into our fund, just having a look at a few of the stocks that we own and are still quite excited about the opportunity set. Remgrow is one. It's a company we didn't own for a long time. Market seemed to love it. Started trading at a premium to its net asset value, which is unusual for holding companies. And then the market started taking a more dim view of it, and shares started trading at a discount, and a bigger and bigger discount to its underlying assets. And our view is it's because of management's lack of action or more passive approach. What happened is we got to a point where we were paying less than 60 cents in the rand for 100% of the underlying cash flows. Now it starts to become a good opportunity. There's asymmetry for our clients. And at the same time, management started acting. They started taking actions. So they started doing things to unlock this value. They unbundled their kind of first rand stake. They worked hand in hand with Heineken to take over Distill. The CEO of Remgrow, Jannie Durant, is the chairman of RMI, which is one of their biggest holdings. RMI acted. They unbundled their MMIs and their discoveries. They sold their Hastings business. They work closely with Vodacom, Vodacom came and wanted to merge with the CIVH business. Now, CIVH is unlisted, so you've got a director's valuation for it. Vodacom, in the deal, made it clear that this business is probably worth 7 billion more than what Remgro were carrying it for. This is because management's not taking action, creating value, and we had a starting point of paying 60 cents on the rand. That tends to be a good investment. There's a whole list of actions they're taking, and we don't think that this is the end of it. But it's a company and it's a holding for clients that we're quite excited about because of everything it brings, and it doesn't need a good economy, a bad economy. It's internal focus. It's going to create value here, and we're not paying near full value for it. Another company, Robex. Robex is a mid-cap road builder that listed in 2007, and the market got very excited about it. It was World Cup, it was Gauteng freeway improvement projects, and the market bid it up 47 rand a share, quick, and then the crash happened. Everyone's aware of how construction companies and the whole sector crashed. A few years back, we started looking at it and thought there could be an opportunity here. This is a business that's very well run, that they've maintained a strong balance sheet, management is aligned, and once again, from the supply side, their competitors are going out of business. Group 5 went under, Basil Reed went under, Avengers SA division went under, Murray sold theirs, and you now have a situation where it's only Wilson Bailey Homes and Robex that have sufficient balance sheet capacity to tender on the projects that government want to put out. So when the market was willing to pay 47 rand for it, the order book was 4.5 billion. Now the order book is 16.5 billion. Now that's because there's fewer competitors. There's more work, there's more renewables, wind farms, solar projects, they tender on it all. There's a lot of work that needs to be done, a lot of bridges need to be built, and there's very few people that are able to tender on it. You get some unlisted players that play in smaller projects, but it's two of them. We're very happy holders. They've maintained their balance sheet. You still have the same management team, and you have a supply side that's constrained, and now a government that's starting to push projects. When the CEO, when we last met with him, said in 30 years he's never seen an environment like this, where there is so much work coming to the market. That typically in future leads to higher margins. So our message is be careful to compare the 38 to the 47. Very different environments, very different situations, and we're still quite excited about the opportunity for Robex in our client portfolios. Made the comment earlier around the leisure companies that had to improve to survive. So Tsogo Gaming is a stock we own, and we had to look at the numbers and what the business had to do to survive. They had to cut costs wherever they can. They had to become a lot leaner to survive. No one had any idea what's going to happen with COVID, how long it's going to last. They were hit by curfews, alcohol bans, social distancing, everything you could think of. So they had to cut costs, because revenue is an unknown. So they cut costs. Now, most of you will know a casino like a hotel, most of the costs are fixed. And then there's high operating leverage, so more revenue drops to the bottom line. So we had to look at what could potentially happen here. We're not trying to make forecasts, but what could happen in a little bit of a normalized environment. So you look at a normal year. Let's just take 2019 revenue, which wasn't a good year. I mean, if you guys recall, just pre-COVID, it wasn't a good economic year. It's not 2006-07 that we're talking about. And then we adjust the costs according to the public formulas in terms of the gaming levies, because that's the biggest variable cost that they have. It gets taken off revenue. So you adjust the last 12 months cost base, now that all the casinos are open, for a higher revenue number, and you have an operating profit level that looks very different to that. We look at the current share price, because we see investors not giving them any benefit of the doubt. You look at the current share price, implies 7.2 PE on the earnings that were generated here. 160 of earnings they did, reported, in that environment. Now it's a leaner, better business. Same revenue, you're looking at a situation where they could do 2.50 rand easily of earnings. On a normal multiple, you've got 200% upside. Now that's not a forecast. The point is, going back to the first slide, why we believe the opportunity set embedded in our funds remains as exciting as ever. There's examples like this. So bringing that all home, we think our funds are positioned in a way that will continue to perform very well for clients. We are very happy to think independently, be pragmatic, and if that makes us look a little bit different, that's fine. We're trying to make the best decisions for clients. We are benchmark agnostic. It doesn't matter to us what is happening in the benchmark. We're trying to pick the best stocks and do the best asset allocation for clients. Be careful to conclude that our funds have outperformed and now the opportunity set is less. You know, you come from a COVID level where it was ridiculously cheap and now it's just very cheap. So I made the example hopefully conveyed how we view it from there. And then we've got the optionality. John had the slides in terms of if the macro starts going in our favor. We're seeing more and more evidence of it. It's not a forecast we're making, but that opportunity is there in terms of the asymmetry. So before we conclude, there are a couple of roaming mics. I don't know if there's questions. If you have a question, it's a big venue. I'd suggest that grab a mic, and we'll take 3 or 4 questions if you guys have, and then after that we'll wrap it up. John. Anyone have any? Yes, sir. Mic here for this gentleman, please.
Thanks. This getting rid of fossil fuels thing is really fascinating now. Trying to go to net zero by 2050, if I understand it correctly, certainly doesn't mean that we can do away with fossil fuels altogether yet by that stage. It'll just be that the way they calculate it will bring us to net zero. And that's 30 years out from now, 30 odd. So what I'm seeing from your presentation is that we've got 30 years plus legs left in, possibly in that environment, where, as you said, the supply is shrinking, but demand could still be there for a very long time. Something to ponder.
I'll respond on that. I mean, what's interesting for me is if you look forward in terms of the potential move across to renewables, in order to actually achieve that, in order to have sufficient fossil fuel power to actually power that change, you have to actually do further exploration. And that's where the issue is that exploration is not taking place. And the known reserves are going to dwindle, and the only way that gets resolved is through prices increasing. And when prices increase, it's all well and good if you're sitting in New York or in Germany and you've got renewables. When you're sitting in emerging markets and you've got a coal-fired based economy, it essentially becomes a tax on the emerging markets. And so it's an incredibly complicated issue. What we do know is we need to move across to renewables, but the assumptions are that it can happen overnight and new technologies will come along. That's not realistic, and we actually need further exploration to enable that slow drawdown of fossil fuels through this period. And it's a complicated one, and people just look at it in binary, and it gets very emotive. If you look at the numbers, it's quite clear. We need further exploration, and there's no point having public listed companies selling fossil fuels and going into private hands where we can't see what's going on. We'd much rather have it in public hands where we can see that they stick to their obligations and we can hold them to the torch, as it were.
Sorry, yeah, so what I'm trying to say is that it's interesting because it almost seems if you just want to try and turn off the tap on fossil fuels, it can actually go against you. It can actually go against the whole idea of being more ethical and cleaner into the future. We need to live with this monster for long. We just need to tame it and keep it in the cage.
Yeah, there's often a trade-off between, when you talk about ESG, the environmental, social, and governance, and if you focus too much on the environmental, there can be massive implications on the social, and it's about balancing those. So within South Africa, we'll talk about a just transition, the move away from coal, but making sure that you don't have thousands of people suddenly unemployed. And we know in South Africa with coal, it's obviously incredibly complicated because if you turn off coal, we're in load shedding right now, it's just going to get worse. So once again, it's about moving beyond the generalizations and actually understanding the subtleties of these things because they're very complicated.
Thanks. Anyone else? Cool. Well, we'll be around afterwards, but let's conclude then, and then we can catch up one-on-one if anyone would prefer that. So fund positioning and strategy. As an example, our balanced kind of Reg 28 retirement fund. We've made the point how excited from an equity perspective we remain about the opportunity set. You can see 75% in equities, 50, just under 50% SA equities, and just under 27% in foreign equities. We remain of the view that our funds remain well balanced, not seeking a binary outcome, and should continue to outperform for clients. The key thing to understand for all of you is to invest your clients' funds in such a way that you are not making a binary assumption on their funds. And we think our funds play a big role in that, in terms of a balanced, pragmatic approach, should this cycle turn. So in summary, we're favoring some domestic shares, the shares that will benefit and are not priced for yesterday to continue. It will not need or require a low interest rate environment. Globally, the same thing. Funds, your stocks that are able to perform in different scenarios. Government bonds, resource companies, we talked about the short duration assets in terms of high dividend yields, high free cash flow yields, and essentially avoiding all yesterday's winners that are priced for perfection, that need a low interest rate environment, that need low inflation. We think the evidence suggests that that might not be the case, and those investors could get hurt. So to conclude, internally, we apply our processes very consistently, very pragmatically, try to stay independent, make the best decisions for clients. We still remain very excited about the opportunity set embedded in all our funds. Very proud of Lyle and his team for winning the Raging Bull on the income fund, and we expect that performance to continue. Be careful to assume that low inflation, low growth, low rates will return and be the norm. The evidence suggests growth could pick up, inflation could pick up, and the consequence will be that rates will pick up. And that has consequences when it comes to where we are in the cycle. I thank you for your time. Really, it was nice seeing you guys. Thanks for coming out, and we'll be around. There are snacks outside, and we'll hope to see you all soon. Cheers, eh?